All right, welcome everybody. We are getting into now the year 2025. I know it's already February, but I'm going to give you a happy belated New Year's anyways, because that's really the topic of today. It's a new year. There's new things going on. We got all these things with Trump going on that we have no clue what he's doing from day to day, but there's all kinds of words and promises and rumors and everything else. And naturally, part of that includes taxes, doesn't it? What are those tax changes that even happened before he became president, but they're enacted now in 2025, and so that's one reason I wanted to bring Devin back again from TaxHive. For those of you guys that don't know Devin, he's like one of the partners in TaxHive. He is like the guy. Like I'm telling you, like I love having these guys back on every single time because they give you such good information. I've had such great feedback from you guys. Not to mention, many of you guys have even hired TaxHive as a result of some of the education that Devin's brought to our Ripplers, right? And so excited to bring him on. Hey guys, go ahead and say hi in the chat. I know you got several of you that have jumped in here live, whether you're on StreamYard, YouTube, Facebook, whatever it might be. Definitely say hi to us. But Devin, let's just dive in. Let's just talk about what's different in 2025 right now.
Yeah, man, it's a wild frontier out there, right? We have the external revenue service now. We got the internal revenue service. Some people are wondering if taxes are going to be abolished or if the IRS is going to vanish. And I mean, I think we're all crossing our fingers, but this is one of those plan for the worst, hope for the best type scenarios, right? That's the world we live in today. And the worst case scenario remains we're all taxpayers and we got to navigate the tax code. But there are some things that are changing or shifting. I'm going to touch on that. There's even some things that are going to get extended. Trump has introduced this no tax on tips, no tax on overtime. They're not in law yet, but they're in the works, right? And so this would probably be not for your filing from 2024, because everything that was applicable and on the books in 2024 has already taken place. But we can hope for a change maybe in 2025 that would impact when we do our filing for 2025 in the year 2026, right? And so let's go ahead and dive right in. For those of you that are tuning in for a second time, if you've heard me before or you're hearing me for the first time, I apologize in advance. I'm teasing you here. We're gonna have a lot of fun. Taxes oftentimes is a heavy, kind of burdensome topic, but we're gonna make it light, have some levity, maybe a little bit of comedy. And if I ever get in a bind, I'm just going to mention my bald head and the glare of the light here in my room off of my shiner here. But I'm going to go ahead and share my screen. And right out of the gates, in fact, one of my first slides is about the implications of Trump. So Chris, I want to say thank you to you and your Rippler community. We're so honored to always be with them. And we feel like there's such a cohesive, just synergy here. And so many overlapping interests. And anyway, so just thank you for having us on. We appreciate the time. And I'm going to be really efficient as we move through the information here today. So let's dive right in. And I'll stay attentive to the chat section or the comments. If anybody has something that they want me to address or be more clear on, throw it in there and I'll do my best to answer it for you. So
and I'll help moderate that too.
Okay, fantastic. That'll work and help.
Since I got the easy job here, I just get to let you ride,
Yeah, you can pilot for me. All right, so I'm sharing my screen or window here, and once I hit play on these slides, sometimes the slide, is it me and Kevin, or is it me and Kevin and all of my notes? Do I need to swap my displays?
Yeah, it's you and Kevin. Yeah.
Just me and Kevin. All right. Well, so this is Kevin O'Leary. I call him my bald brother. If you've interacted with the TaxHive before, I don't need to spend too much time on this, but Kevin O'Leary is an equity partner in the business. He's not just a friend or a paid spokesman. He's actually an owner in the business. And I think that that's significant for a number of reasons, just from a credibility standpoint. I mean, the amount of due diligence and screening that we had to go through as an organization to even have Kevin's team sign off on him being associated with us was extreme. I mean, Sony, the Actors Guild, and all of the forensics that they did, you can just know right up front, you're dealing with people that are, not your average tax and accounting firm. And as we move through this information, my hope is, my goal, just to give you, I always like to give the 40,000 foot view with the end in mind. What does the end look like? I think the end looks like this. It's you guys engaging with us and saying, oh, hey, yeah, Devin shared some insightful things. There were a few clues along the way that made me think, man, TaxHive could probably do a better job than my current accountant or CPA. And I'd like to explore that with them. If that's you, let's start with the end in mind. There's an opportunity for you to engage with us, hop on a phone call, and you don't have to do it right this moment, but I just wanted to kind of train your eyes a little bit to say, at any time that it's the right fit for you, you can scan a QR code or you can go to taxhive.com/ripples and you can schedule an appointment on our calendar to talk with a member of our team. That's how we work. It's very simple. So right out of the gates, you can all put yourselves at ease. There is no ask here today, for a credit card or an invitation for you to, get your Visa or Amex out. We're not going to get into that. It's strictly hey, if you'd like to have a conversation with us, that's best suited one-on-one so that we can assess your situation and see if we're the right fit. Now, we've already brought up this new presidency, right? What are the implications of Trump? Well, there's a quick history lesson here that we kind of need to address, which is back in December of 2017, Trump signed the initial TCJA. The TCJA was the Tax Cuts and Jobs Act, and it had a few benefits for, wage earners, particularly within certain income brackets. And those credits or those cuts and that Jobs Act is set to expire here at the end of 2025. All signs on social media and in the news are suggesting that Trump is trying to keep more money in the pockets of Americans. And so I would estimate that and project that those things are going to get extended. The expiration is not going to happen. If they do, though, right, this is the hope for the best, plan for the worst. If they don't get extended, well, then tax brackets increase. We would go from if you're in a 12% tax bracket, you'd go to 15. If you're in a 22 to a 25, 24 to 28, you can see the rest on the screen there. Those are the changes if the TCJA doesn't get extended. There's also a child tax credit that got doubled under the Trump tax cuts. And if it doesn't get extended, then that child tax credit would get reduced by half. It would go from $2,000 per child to $1,000 per child. There's also this qualified business income deduction of 20% that would expire. And these are just a handful of things, right, that are on deck for this new presidency. And I think the mood and the feeling generally in along the tax front is that Trump and his administration want Americans to succeed. They want all of us as business owners to keep more of our money, and that's the way that the economy is going to be, revitalized and boosted, and overall that we're better off as Americans if we can keep more of our money. And I think generally, whether it's the TCJA or other things like not taxing on tips or not taxing on overtime, right? There's probably a myriad of other ways that Trump is going to try, and his administration specifically are going to try and just keep more money in our pockets generally. I think that that's the mood. That is what the news is implying. And if we just take this in the here and now, like what's happening right now, I always like to ask my audience, people that I'm speaking to, hey, what is your current scenario like? Like, how much are you paying in taxes? And do any of you have an idea of what you're paying? Like, anyone in the chat want to share with me what you're paying? Is there a percentage that comes to mind? When I ask this question, almost always, and you don't have to participate, sometimes we have a shy group, but when I ask this question, usually the immediate kind of knee-jerk reaction is that, oh yeah, Devin, I pay 20% or I pay 30%. And it's almost always through this filter of how much do I pay in income tax? And Chris has heard me say this before, but okay, I've got a couple of you in the chat. Okay, this is you, Chris, saying, hey, I budget about $100K, right, for taxes. I appreciate the participation. Well, whatever your number is, the sad reality is that that's not the only tax you and I pay. We always think of income tax, but we pay property taxes, sales tax. We're taxed when we make it. We're taxed when we buy it. We're taxed while we own it. We're taxed when we sell it. In the case of healthcare, you're taxed if you don't buy it. Look at your phone bill, your gas bill, capital gains. It's tax, tax, tax. I had somebody the other day that was like, I don't think I pay that much in tax. And I'm like, well, have you ever purchased a license? Have you ever gotten your car registered? All of those things are taxes. It's money that goes to either a state and local government or a federal government. And all in, at the end of the day, it's probably safe to say that you and I pay somewhere between 40 to 60% of every dollar to some version of a tax. And yet, you and I haven't really discussed how we can minimize that yet. That's part of the conversation today, right? Is, okay, so then how do I pay less? Well, guess what? Only one of those items is negotiable. You can't negotiate your I guess you could submit an appeal to the county assessor. Good luck with that. But generally speaking, right, you can't go to the cashier at the grocery store and say, hey, no, I don't pay sales tax because I'm a business owner, or I have dependents, or I have a home office deduction, or I have a corporate vehicle, right? Edna at the cashier, she's going to laugh you out of the store and say, no, yeah, hey, sales tax is sales tax. The one tax that is negotiable is income tax. And the way that it's negotiable is via the tax code, right? It's been written to incentivize us and to help us. But I want to have an even more clear conversation about this, which is, okay, if we pay a lot in tax, what is the long-term impact of our tax scenario overall? And if you've listened to me before, this is something you'll be familiar with. So I'm going to fly through this. This is the dollar that gets up every single year for 10 years. At the end of 10 years, business owner, as an entrepreneur, as someone that grows your money, right? And as money ripples, well, when it ripples, it tends to grow. If we doubled our money every year and we started with $1, at the end of 10 years, you've got $1,000. Well, this starts to get really impactful when we get out to 20 years, because now you've got $1 million. And I know many of you are thinking, Devin, it doesn't take me 20 years to grow $1 million. Okay, well then, run this through the filter of whatever caliber of success you've achieved and however quickly you grow money. But I'm trying to be somewhat reasonable here. The unique thing that you see here on the screen is that our money grew. Our investment was with no what? With no tax. And I don't know what world you live in, but that doesn't exist, right? We all pay some version of a tax. And in order to wake you up about the cause and effect of taxes and what it's actually stripping out of your bank account, out of your pocketbook every single month, right? Or every single year, is I want to do this same illustration, but I'm going to introduce a 15% tax. As this scrolls through and illustrates the change, I want you to think for a second, why would Devin show the number 15%? Because we just had a conversation that our overall tax scenario is more like 40 to 60%. And this, again, is just TaxHive trying to be realistic. It's not that we never bring someone down to zero from an income tax perspective, but it's super, super fair and reasonable for us to say, we're going to make a 15% improvement. We're going to make a 15% adjustment. And this indicator right here is to say, if you don't, what if you don't? If you don't make a 15% improvement, well, then here at the end of 10 years, already half of your money is missing. Who got the money? Think about that for a second while I show you the next 10 years. When we get out to 20 years, well, instead of having $1 million, we now have less than $250,000. And the question that is begged here is, where is the money? Like, where did the $750,000 go? If 800 grand was missing from your bank account, you'd probably want to know. And I'm interested, Michelle or anybody else in the chat, somebody want to give me an answer? Where do you think the money went? Did the government get it? Did your dog eat your homework? Did it, fly away in a hot air balloon? Where is the money? And okay, I'll answer the question. Many of you probably thought to yourselves, hey, Devin, yeah, the government got my money. No. Look in the bottom right-hand corner. The government got 51 grand. This is part of the problem. It's a very sneaky way for you to lose a ton of money, is that over 20 years, nobody is raging mad that they paid the government 50 grand. And yet, in this illustration, we just lost $750,000 because why? Because the money never had the potential to grow. The money never rippled, right? It never had the capacity to grow over time, and therefore it was usurped, or dare I say robbed, by a simple 15% tax because you didn't have the opportunity in your business to grow that money. So let's talk specifically about one scenario, a little bit of a step out here for you. Now that we've kind of woken ourselves up to this 15% implication, Well, now all of the new tax strategy and the things that are happening have a very real impact for you and your business. I want to speak to some of you that maybe are still a W-2, right? It's not uncommon. I'm one of them. I have W-2 income. I also have business income, across my other operations and businesses. So how does the W-2 work? Well, the W-2 employee, because you're not providing opportunities for others, because you're not employing other people, because you're not risking your capital, you are an employee of the business, you have very limited deductions in the tax code. To give you some, right? You have charitable donations. You can write off the interest that you're paying on your mortgage. You have an alimony. If you're paying alimony or child support, there's a deduction there. IRA contributions, student loan interest. These are the most common ones. There are about 12 that may or may not apply to most people. But here at TaxHive, we know and understand all of those W-2 deductions, and then we are the experts on all of the business side of things. And whether you're a W-2, a business owner, or you're both, TaxHive can help you, right? And so I just want to make that abundantly clear. There are some things in the code that you should be taking advantage of and that your accountant should be very aware of, which brings me to my next point. There is an old way and a new way of doing this. And let me just illustrate for you the old way. The old way is what many of you have already been doing for years and years. I call it the yellow pages strategy. It's like, go to the yellow pages if they still existed, right? And find accountants or CPAs and call one up. And it's usually a front desk employee that's managing the schedule and one or two accountants that do your tax preparation. That's the old way of doing things. The old way is not necessarily wrong. It's just a little bit old-fashioned, and it costs you a lot of money. The old way is you hiring a tax preparer and assuming that that tax preparer does all of the things that you want them to do, which is save you money on taxes, when in reality, you haven't hired them to do any of that other than the tax preparation. That's the old way. They check boxes, they punch numbers into certain fields, and at the end of the day, they operate like a cashier and they tell you what you owe. I'm not trying to disparage or attack any of my accountants out there. They're great. They're doing what you paid them to do, but the old way doesn't save you any money. The new way of doing things, when you run through the filter of TaxHive and our strategic tax planning, the difference is this. Old way says, hey, I'm going to look in reverse. I'm going to look back in time and see what happened. Whereas the new way says, I'm going to look forward and I'm going to anticipate. I'm going to game plan the same way that the Philadelphia Eagles, whether you wanted them to win or not, the same way that they looked forward and said, I'm going to game plan, I'm going to strategize, and we're going to run this play. We're going to implement this strategy, this tax deduction, this tax gap, this strategic credit, or this dynasty strategy. When you look at it in a forward-thinking manner, there are all kinds of opportunities within the tax code. And the very clear distinction that I need to make here is that the old way of looking backward and the new way of looking forward is a difference of tens of thousands of dollars. And it's the difference between tax preparation and tax planning. Strategic tax planning says, hey, in advance, before we ever take the field, or even while we're on the field at halftime, right, or on a quarterly basis, right, we review our tax scenario and we ask ourselves this question, which is, what of the four pillars are we implementing right now? Are we maximizing our deductions? Are we taking advantage of the strategic credits, the tax gaps, and the dynasty strategies that are in the code and available for us to take advantage of? And I'm going to review these all here with you here and now. Going to give you some examples of each. But as we go through this, I just want to put all of our cards on the table and say, hey, when somebody scans a QR code and they have a conversation with TaxHive and they say, hey, yeah, I want the new way. I want to be forward thinking about my tax scenario. This is what happens. We identify a grundle of savings. And I say a grundle because, it's anywhere from tens of thousands on up to hundreds of thousands of dollars for a client. Now, you might say, well, how do you do this? Well, that was the last slide, right, with these four pillars. And I'm going to show you more of that here in just a second. But then you might also ask, Devin, how did you guys land on these numbers? Well, when we deliver a tax plan to a client, it identifies all of the opportunities within the code. But before we deliver that plan, we understood some basics about their business, particularly their revenue. Gross revenues have a very direct tie to the amount of opportunity that exists in the code for you. And so what you see here on the bottom row, it says business revenue. It's like, well, okay, if I'm doing my first 100 grand, well then on average, and this is not like a sample size of 50 to 100 clients. This is close to 3,000 different tax plans that we've delivered to clients. And we said, based on their business revenue, was there a correlation as to how much we identified in savings for them? And there was. And this is what it amounted to be. Let's pretend for a second, if you scroll over on the business revenue along the bottom and you say, hey, my business right now is grossing somewhere between 350 to 700 grand a year. It's like, okay, well then fantastic. You've got about $40,000 to $70,000 of opportunity on the table, ready for the taking right now, if you have a forward-thinking approach. And the forward-thinking approach, again, is all about maximizing your deductions, which, by the way, there are over 1,400 deductions in the code. And right now, you're probably only taking advantage of the home office deduction or a corporate vehicle. Maybe you're hiring your kids, right? But all of the other ones, how are you going to figure out which ones are applicable to you and which ones apply to or are legally within, scope of your business to take advantage of? Second item are strategic credits. These are all about, work opportunity tax credits, R&D tax credits. I'll show you these here in just a second. Tax gaps, and then dynasty strategies. I want to start with the dynasty strategies. This is usually like the big hit for people. It's like, this is a monumental shift. We're not saving a few $1,000. This is tens of thousands of dollars that's on the table for you. And so let me show you this dynasty strategy right here. This is probably one of those, hey, if a light bulb goes on for you while we're having this conversation today, this would be one of those moments, because my guess is most people I talk to are like, Devin, I've never heard of that. I've heard that I can write off my charitable contributions, but I've never heard of an accelerated donation. So watch this. This is something that if you ask yourself, has my account ever told me about this? And if the answer is no, you might want to scan a QR code, right? So let's pretend for a second that you owe the IRS $100,000. Maybe you're like Chris, right? He's kind of allocated about 100 grand every year that's going to go to income tax in some form or fashion. Well, you could take that same 100 grand and say, hey, I'm going to do something different with those same dollars. And I want to be clear about this. We're not grabbing new money out of your bank account. This is money that was already going to be allocated towards income tax. And if we take those dollars and we say, okay, let's not take all of them, but let's reallocate half of them. Let's take 50,000 and let's donate it to an eligible nonprofit. The eligible nonprofit, again, I get people that are like, is that like my local community food bank? Is that my local church? No, it's an eligible nonprofit that has been kind of signed off by the IRS and at a federal level has permissions to give you this accelerant. Well, the accelerant says, take, for instance, like the Red Cross would maybe be a reasonable example at certain times. When we make this donation, because of the social impact or because of the very targeted outreach that this charity has, there's this tax benefit. It's usually a 4 to 6 multiplier. I like easy math, so we're going to use a 5 times multiplier. If you times 50 grand by 5, you get a total deduction of $250,000. And I need you to pump the brakes for a second, because you didn't just save $250,000. You got a deduction of $250,000. So we donated $50,000. The deduction of $250,000 has to run through the filter of our tax bracket, which if you're in a 32% tax bracket, that's an $80,000 savings, except, hold on, we still donated $50,000, right? So if you take the 80 minus the 50, the net effect is $30,000 in your bank account that didn't exist a few minutes ago, right? Let me illustrate it for you one step more clearly. Instead of paying the IRS $100,000, we paid them $20,000. We donated $50,000, and we kept $30,000 in your bank account. And I don't even need a show of hands on this, just rhetorically speaking in your own head. How many of you like that a whole lot better than you like sending 100 grand off to the government, right? And if anybody disagrees on me with that, well, I'm not here to convince you otherwise, but I think generally most people would agree our government is a really bad steward of money. It would be well better served in your business within your marketing, budget, within your personnel to maybe pay better wages or bonuses to your people, better distributions to your partners, adding a second location, buying more inventory. There's a lot that you could do with that money. And if you already have an idea of, hey, Devin, if you guys can unlock 40, 50, 60, 100 grand in potential savings for me, I'm probably willing to have a 10-minute conversation about that. Well, then this is the moment where I'll make a little more clear, direct, call to action to say, don't be passive. Don't sit on the sidelines. Don't continue to waste money and overpay on taxes. Do something about it. Schedule a free strategy session, scan the QR code, go to taxhive.com/ripples, and you can schedule an appointment at your convenience when your schedule allows. But I'd highly recommend doing that now. And here's what typically happens. When we talk with clients, we find that most people don't have a whole lot of confidence in their current accountant's ability to maximize their deductions for their business and keep them compliant with the tax code. This is really worrisome, but I'm not super surprised by it because most accountants take the easy route. They're a little bit like the conveyor belt, right? That just is process oriented and says, I prepare and file taxes, and here's what you owe, here's what you owe, here's what you owe. And they send you an invoice for $300 to $500, maybe $1,000 or a couple $1,000, depending on your business structure, right? And I think at the end of the day, you have to ask yourself, am I okay with the old fashioned costing myself a lot of money, or am I ready for something new? The old versus the new. And if you're willing to do something about it, I feel like that is the next step, right? We want people who are action takers. Kevin himself is big on, being a person of action and being decisive. And he would say, and I don't really love this word, but he says, hey, shame on you if you don't plan for taxes. I think he'd really say, you probably deserve the penalty of overpaying if you are unwilling to plan. And I'm not here to shame anyone. In fact, I'd rather love you into it than shame you into it. But Kevin's kind of that straight shooter. He's my bald brother, so I'm not gonna back away from anything that he said. But I just think that as a business owner, you owe it to yourself, you owe it to your partners, you owe it to your employees, even to your customer and your family to get this right and to keep more money in your operation. We talked about the cost of doing nothing. We know what that looks like. It's that same reward of, on average, a tax plan with TaxHive to a business owner delivers somewhere between about $40,000 to $70,000 of identified savings. How is that even possible? Well, it's because of the tax code. And I know many of you feel like, man, Uncle Sam is pointing the finger at me and he's jumping into my wallet and he's trying to strip as much money out of my business as he possibly can. Well, it's actually kind of the opposite. The tax code was written to specifically incentivize the behavior that the government needs and wants from us as business owners. They want you to risk your capital. They want you to risk your time and your intellectual property, and they want you to hire people. They want you to help grow the economy. And if you're willing to do that, well, then guess what? There are over 6,000 pages of tax code. There are over 70,000 pages of legislation that's been written to interpret that tax code because it's the behavior that the federal government not only wants, but they desperately need from us. The government does not create jobs. You and I create jobs. We're the entrepreneurs. We are the engine of opportunity in our economy. And it was written to incentivize investing because they know and understand that, right? The IRS, let's be clear about this. Who are they? They're the world's largest debt collection agency. Pause for effect while I get a drink here. The IRS wants every penny that they are owed, but not a dollar more. And you might say, okay, Devin, well, that's an interesting point because the tax code over here on the left-hand side probably says that I owe this much. And yet my accountant right now, because he or she is afraid, or maybe they just don't understand the code, or maybe they're just a big chicken or a weenie, right? They have you preparing and filing your taxes way over here. And the gap between the code and where you're currently filing is all of your money. And I always say, hey, convenient for your tax preparer to not really care, because in between the code and where they currently have you filing is a whole lot of work and effort and intellectual property on their part to be able to tell you and implement and instruct you on what to do. Most of them are not capable of doing that. And so they just simply don't. The others that do know how to do it, they're not doing it for you because you're not paying them to do it, right? So I want to be clear here. You can get as close to the code as you want, and we recommend getting as close as you can. And some of you might say, ooh, Devin, like that's, that might trigger an audit, or that's a red flag strategy. We don't teach any red flag strategies. We only teach and implement and help our clients with things that have legal precedent, that are squeaky clean for you to implement. And if, God forbid, if at any time the government comes knocking, right? The IRS says, oh, hey, there's not like the FBI doesn't show up, with guns and body armor. It's a paper audit. It's, hey, you implemented strategy XYZ. Can you document that for us? Can you send us over the paperwork that you filed or the notes that were taken during that meeting? It's like, yeah, I did this all by the book. TaxHive helped me. Here are the docs. It's like, great. Thanks for doing that. Have a nice day, right? So when you pay taxes, you have three options. You can pay taxes now, you could pay them later, or you could pay them never. And I think I can anticipate what one you might like here. Now is a W-2. Later is like a business owner who does a quarterly estimated return and they square it up later, right? Never is when money comes into your bank account and you literally pay never on that dollar because of the tax code, because of deductions, credits, gaps, and dynasty strategies. And never oftentimes scares people. Like I'll sometimes ask audiences, like, which of these three scenarios do you like the best? And some people are too afraid to even say it out loud. They're like, I think my Alexa might be listening to me. And I'm not willing to, put out in the ethos or into the atmosphere that I want to pay never, because maybe that's the Wesley Snipes, Al Capone, I'm going to end up in prison strategy. It's not. The only way that you pay never is one of two ways. Number one, don't make any money. Okay, so yes, that's true. If you don't make any money, you'll never pay taxes. It's just a horrible goal. None of us want that. So the alternative is make all the money you can make and then use the code to your advantage and utilize strategies that keep money in your bank account. I'm going to go through these strategies right now. I'll show you a couple of customer examples. I'm going to fly through this. You guys already know a little bit about TaxHive. We're an advisory firm. That's what sets us apart from everyone else in the yellow pages, is that we not only do tax preparation, bookkeeping, and tax compliance, but it's the advisory services. It's the strategic tax planning that sets everything apart. And guess what? If you love your aunt or your uncle that's been doing your tax prep for you, let me be really clear on this. That's totally fine. You don't have to fire them in order to work with us on the strategic side. You would just, when you go to file with them, you'd have a better set of facts and circumstances and receipts in a box to deliver to them, right? That's going to allow you to pay less. When you work with TaxHive, I just want you to know you're working with a highly reviewed, highly rated, reputable source and company. We're experts at what we do. We're now over, I think, 2,500 Google reviews, close to 1,000 Trustpilot reviews, A+ rated with Better Business Bureau. All of you, I don't need to waste time on this. Just know we're a business of people. I know we're not perfect. Where we've made mistakes, we've owned up to it and we've made it right with the customer, and we treat those like opportunities to over-deliver for those people. So let's dive into these deductions. Standardized deductions would be home office. Well, guess what? On the home office deduction, probably didn't know this, your accountants maybe never even told it to you. There are two different versions of the home office deduction. Which one is more suitable for you? Which one would save you more money? Those are the things that we dive into at TaxHive. Take, for instance, also your corporate vehicle. Do you write off the mileage, right? What's the depreciation schedule like? Do I lease my vehicle or should I purchase the vehicle to own it? All of those things have tax implications. Now, I want to show you a real customer example here. This is Carrie and her notary business. She had 28 grand of identified savings in her tax plan. This is significant. Carrie had, over the next 5 years, she has over $140,000 of potential savings that she could capture. And I know what you're thinking, hey, a small little notary business, I don't know actually the size of her operation. But the most glaring thing to me on this entire slide is that she's been in business for 20 years. I mean, how much money How much opportunity did she leave on the table that she just overpaid on taxes because she never knew about the strategy? And one strategy in particular within her tax plan, one of them identified over 15,000. One strategy, 15,000. Do you think she implemented that one? I think so, right? It was a slight modification to her corporate structure. Your corporate structure matters. Whether you're an LLC, whether you're, you take an S election, or you're a C Corp, or you're a sole proprietor, or all of those things have tax implications. And so are you structured properly, right? Those matter for deductions as well. When we get into strategic credits, I always like to talk about the most recent one. It's no longer available. It was the employee retention credit. COVID, right, had our government in shambles, and they were like, man, we don't want the economy to fall off of a cliff. So let's just use tax dollars to subsidize wages. And they gave us as business owners the employee retention credit that simply said, if you'll keep your people employed, well, then we'll subsidize their wages with a tax credit for you. That was the ERC credit. Well, the ERC credit has expired. And now today you have work opportunity tax credits. These are, if you're willing to hire people in certain geographies or from a certain, demographic or a certain opportunity zone, there are tax credits for you as a business owner. It's, commonly, if you see this in like Reddit or YouTube, it would be a WOTC, the work opportunity tax credit, which, quick warning, YouTube and Reddit are not a reliable source for tax planning. I sometimes have people that are like, oh, yeah, Devin, that's nothing new. I've heard of that. And it's like, okay, great. So when did you implement it? Have you been utilizing the strategy? No, I just heard about it on Reddit. It's like, right, because when you find something on the internet, A, it's hard to believe. B, it doesn't oftentimes give you the full scope and view of what you need to understand about that specific strategy. And you might be a little bit nervous or apprehensive about trusting what you found online and knowing whether or not it applies to you, right? So be cautious out there. You need to be working with experts and doing it the right way. Matthew here and his company out of Virginia, they have the vehicle plug-in tax credit. What is that? That's an electric vehicle, an EV charger. You guys all know there are solar credits, battery backup credits, EV charger credits. When you go solar, when you go green, the government right now has all kinds of incentives and credits available to your business. There's also this one, the R&D tax credit. This is like research and development. If you help fund or pay for, or if your business is participating in research and development, there are opportunities for you to get your equipment paid for, your wages paid for your employees. The R&D tax credit was applicable to Elias and his business out of California. Oftentimes when I show strategic credits, people just assume, well, Devin, I'm not Warren Buffett, or I'm not Elon or Jeff Bezos, and so these things probably don't apply to me. You guys, please, there's nothing unique about these gentlemen other than the fact that they have a team of strategists that probably on a daily, weekly, or at least a monthly basis are looking at their scenario and optimizing it for a tax scenario to say, where can we save money? Where can we recapture? Where can we reallocate? And they are utilizing the code to its full capacity, right? They don't have little chicken weenie accountants that are going, ooh, I don't know, that might trigger. No, it's the code is what the code is. And if you have a team of professionals that know what they're doing, well, then you have the potential to save tens and tens of thousands of dollars via all of these strategies. Now, tax gaps. This is something that's fun. Everyone should put this in your notes. Write down Rule 280A. If you've been on a call with us or you've been into the TaxHive office, we've probably talked about this one because it has almost universal application. There are other tax gaps like depreciation, bonus depreciation, other retirement accounts that have savings. When you put them in the gap, you can capture those dollars. One of the fastest ones that has almost universal application is that you as a homeowner can rent your home out to your business up to 14 times a year and do it tax-free. You heard that correctly. It's Rule 280-A. It's also known as the Augusta Rule. I'm not going to get into the folklore of why it's nicknamed the Augusta Rule, but it essentially says, hey, like someone who owns a home at the Masters in Augusta, Georgia, that might give you a clue, I can rent my home out up to 14 times a year and do it tax-free. wow, I wonder who in Augusta, Georgia knew a lobbyist or a legislator and got that one passed. Well, I don't want to speculate, but at the end of the day, the same rule applies whether you're in Augusta, Georgia, or you're, in your home state of Alabama or Utah or California or Texas, wherever you are. Rule 280A, you can rent your home out for a reasonable rate up to 14 times a year, the same way that you would book a Hilton or a Marriott property and book a ballroom or a meeting room with them. The expense is deductible to your business. The income is tax-free to you on an individual basis. You actually have to host a meeting or a team building event or some kind of, networking opportunity. You got to do something. You can't just pretend, right? You have to actually hold the meeting, keep the notes, invoice your business, and get paid for it. So let me show you this. This is Alva out of Kentucky, over 26 grand of identified savings. Her tax plan had the Augusta rule, had bonus depreciation, had a handful of other deductions that were available to her within her tax plan. Here with Tam Lynn and her massage business out of Texas, over 16,000. She had the Augusta rule. She had the S Corp election. She had some retirement strategies and dynasty strategies, which brings me to my next point. I already showed you the accelerated donation. If you weren't on the call for this, I'll fly. In fact, let me just skip to the next slide. Instead of donating 100 grand to the IRS, and I say donate kind of tongue in cheek, instead of paying the IRS 100 grand, we paid the IRS 20,000. We donated 50,000 and we kept 30,000 in our bank account. If you're thinking, hey, Devin, this sounds like a great dynasty strategy, but like, what else? What else is there? Okay, so put in your notes. Oil and gas, mineral deposits, cost segregation, conservation easements, solo 401ks, other retirement accounts, captive insurance. Dynasty strategies are incredible. And in addition to this, if you're a W-2 wage earner, you can use dynasty strategies for tax benefits. This is like one of the gaps that most people don't recognize. They're like, oh, I'm just a high wage W-2 earner, and therefore the tax code doesn't apply to me. No, actually, it does apply just on the dynasty strategy side or on the small deduction, 12 standardized deduction side of things. It's the business owner that gets all of the other deductions, the credits, and the gaps. But dynasty strategies that I just mentioned, those have application to W-2 wage earners as well. Here's another client example. Junius and his business out of Georgia, almost $30,000 of identified savings. He had the reallocated investment strategy, the conservation easement. That gave him about $12,000 in federal savings, $2,500 in state savings. He also had Rule 280A in his tax plan. Here's a moving business. I love this one. Like, I love it, because a lot of business owners oftentimes are like, oh, well, Devin, I'm just a plumber, or I'm just a roofer, or I work in this trade, or I do e-commerce. I'm just kind of a small fish in a big pond. It's like, I don't know, a moving company had $73,000 of potential savings, right? So don't ignore the opportunity. These things are very real. And if I went through this with you on Jared's moving business, they had an oil and gas reallocated investment strategy. That was $36,000 of potential savings. He had captive insurance, which was $14,000. He could hire his children, which was another $5,000 to $6,000 of potential savings. These things start to add up very quickly, and they compound over year, right? That if I save 70 grand this year, I've got that money to invest. I'm going to save another 70 grand maybe the following year. This is not a one and done. When you get a tax plan, these things have future implications on all upcoming years. I already showed you this slide. This is both the cost of doing nothing and the reward of doing something. My dear bald brother, Kevin, would tell you, hey, you work so hard to grow your business. Don't overpay on taxes. Like, why on earth would you do that, right? Well, a couple of reasons. Ignorance, laziness, or maybe you just really believe in our government's ability to be a good steward of your money. I don't know. But I think the alternative of keeping it in your bank account would be priority number one, which brings me to my final invitation with you. Hopefully you've learned something here today. I would maybe ask just rhetorically, how many of you learned something new? How many of you saw value? And if that's you, how many of you not only saw value, but you're also willing to do something about it, and you want to scan a QR code? You'd like to have a private 10, 15, maybe even a 20-minute conversation about your scenario that says, hey, simply, Devin, what do you own? Where do you own it? What is your corporate structure like? What's your revenue like? And we'll go to work for you. We'll start to identify opportunities for you, and to kind of, pull the rabbit out of the hat a little bit and give you some anticipation here. We do the analysis on your prior year's tax return, and our guarantees, our warranty of identified savings is usually double or triple what it would ever cost for you to do business with us. And if we can't double or triple that, we refund your money. That's A. But B is that guarantee is in addition to anything that you might already be doing. Most business owners that I meet with, they're like, yeah, I'm doing a few things. This would be in addition to everything you're already doing, right? So my invitation is scan the QR code, go to taxhive.com/ripples. My team has specifically opened up slots in their calendar to take care of Chris Miles's group. All of you Ripplers, got to schedule that call. Let's take advantage of the opportunities that are available to us right now in 2025. If you delay, every month that goes by is a month of missed opportunity that you're going to end up overpaying on taxes. And far too many business owners wait until the fourth quarter. And they're like, oh, dang, I'm Patrick Mahomes and I'm down 32-6 or whatever that crazy score was. And it's like, hey, you've seen it in the NFL. It's going to happen to you in real life in your business. It's too late. Don't wait. Get in front of this way ahead of time. Do it the right way, and we'll be your friends in the tax planning world. And with that, Chris, I'll turn it back over to you. I don't know if I missed anything in the chat, but it looks like you guys have been helping me out, and I appreciate your interactions here. Ken, Danielle, Paul. Let's see. Did I miss one question from Michelle, or did you take care of that for me already, Chris?
Well, Michelle said this, just talking about all the different strategies she has to learn her first situation. And she said, hey, I scheduled my call.
Oh, fantastic. Love it. Love it. Well, thank you, Michelle. You're in good hands, and we're going to, take fantastic care of you. A little white glove treatment always for the Chris Miles group. So Chris, thanks for having me on, man. Any other things that I didn't cover or that you wished I was going to touch on today?
No, you covered it. I mean, you answered our questions like with the tax changes. Obviously, there's still more to go, but I am a little bit scared about that. The previous one that Trump had put into office. The Tax Savings Act that we had before. I mean, that's a big one. I mean, losing that 20% deduction for business owners that that make or have adjusted income under 320. I mean, that's a big deal.
Yeah, massive deal. Alongside just the change in the brackets. I mean, imagine going from 22 to 25, that extra, 3%, it's a couple thousand, if you're a higher wage earner or you got a lot of revenue coming in, it's like those numbers matter. And yeah, certainly pay attention to it. Follow us here at TaxHive. When you become a client, here's the other cool thing. I haven't even mentioned this. It's just kind of like ancillary stuff, but I know we're short on time. When you become a client, we keep you in tune with everything that's happening in the landscape of taxes. And here's how we do it. If you think for a second, when was the last time you talked to your accountant? Maybe in the last week because April's coming up. But prior to the last week, it was probably 6 or 8 months ago that you had a conversation. Well, here at TaxHive, we like to connect with our people twice a week. Twice a week, we offer a Ask a Tax Pro session. It's a live setting with one of our most qualified senior tax advisors, and the community collectively can ask questions that oftentimes you're not even thinking of asking, but because you're on the Ask a Tax Pro, you found out someone else's question, you were able to take it back to your business. And so we're staying in tune, keeping our people updated and abreast of what's happening out there. And so anyway, you're in good hands with us. We look forward to the opportunity to potentially be the right fit for you and earn your business. And again, Chris, thanks so much, man. I love being on with your people and love the relationship. And, God bless everyone. Wish you the best of success, whether you're in the hive or not. We love you.
Yeah. And Devin, I'll throw out one more shout out for you too. I mean, you guys talk about that promise of trying to do at least double, in savings for what you charge. And I actually had a client reach out recently that said, listen, like they honored it. They tried. In our situation, wasn't quite enough. And so they refunded us the money. And so, and that's not just a sales tactic that you use. It's legitimately, you guys really do honor your word on that. In most cases though, I mean, people do find tax savings, but
don't get us wrong. I mean, we honor it where it applies, right? But don't get us wrong. Yeah. It's a safe bet on our part. It's usually well north of double or triple. I mean, it's astounding how much money is available to people. So yeah, I appreciate you mentioning that. We are people of our word. If we can't improve your situation, yeah, then here's your money back, right?
Yeah. I mean, imagine if you got billions of dollars. I mean, with all these people you've saved, I mean, what that does is create a ripple effect in through the business owners' lives and for the people they employ. I mean, I, I like you. I don't trust the government will be the wisest steward of the money. You know, I do believe that we, especially as business owners, can be the wisest stewards of those money. We can create more with it. We can employ more people with it, way more than welfare can do. That's my own personal little 2 cents there, but I won't get too political on you guys. But either way, you're up to some great good, and I really appreciate your time, Devin.
Absolutely. Well, it's been a pleasure, and we'll see you guys on the next run. But yeah, looking forward to have that conversation with you. Our team's going to take great care, and as always, Chris, thanks a lot, man. Take care.
Thanks so much, Devin.
Okay. Bye-bye.
Bye.